Your retirement account is not yours. I need you to understand that sentence. Read it again. Your retirement account is not yours. You think you own it. You've been contributing to it for decades. You watch the balance grow. You plan your retirement around it. But you don't own it. You never did. And the government just made that brutally clear with a rule change that gives them legal authority to seize physical precious metals held in retirement accounts. Not tax them, not regulate them, seize them, take them, confiscate them without compensation beyond whatever arbitrary value they decide to assign. This is not conspiracy theory. This is not fear-mongering. This is a regulatory change that was published in federal code, buried in hundreds of pages of tax law amendments, hidden behind bureaucratic language that most people will never read. But I read it. And what I found should terrify anyone who has precious metals in an IRA, in a 401K, in any tax-advantaged retirement structure. The mechanism is now in place. The legal framework has been established. And the precedent for this kind of confiscation already exists in American history. In 1933, the government confiscated gold from American citizens. They called it voluntary surrender, but it was backed by criminal penalties including 10 years in prison and fines equivalent to millions in today's dollars. They paid $20.67 per ounce for gold that they immediately revalued to $35 per ounce after the confiscation was complete. The citizens who surrendered their gold lost 40% of their wealth overnight to a government that lied about the value. That was gold. Now they're coming for silver. But this time, they're not sending agents door to door. They don't need to, because you voluntarily put your silver into a system they control. You put it in an IRA. You put it in a self-directed retirement account. You did it because the tax benefits seemed attractive. You did it because financial advisors told you it was smart. And now that decision has given the government a direct legal pathway to take your metal without ever setting foot in your house. Let me show you exactly how this works. Let me show you the specific rule changes. And let me show you why this is happening right now, at this moment in history, when the financial system is under more stress than at any point since the Great Depression. The rule change I'm referring to is buried in Section 72 of the Internal Revenue Code, specifically the amendments related to prohibited transactions and excess accumulation penalties. Now, I know your eyes are already glazing over because tax code is designed to be incomprehensible. That's intentional. They don't want you to understand it. But here's what it says in plain English. Under the new interpretation, which was quietly adopted through regulatory guidance rather than legislation, the IRS now has expanded authority to determine what constitutes a prohibited transaction within a self-directed IRA. Previously, a prohibited transaction was clearly defined. You couldn't use your IRA assets for personal benefit. You couldn't live in a house owned by your IRA. You couldn't borrow money from your IRA. Simple rules. But the new guidance introduces something called materiality assessment. The IRS can now determine whether the assets in your IRA create material risk to the tax-deferred system. And if they determine that your holdings create such risk, they have authority to mandate restructuring or liquidation of those assets. Let me translate that. If the IRS decides that your physical silver creates a risk to the retirement system, they can force you to sell it. But here's where it gets truly sinister. The rule doesn't specify what market you have to sell into. It doesn't guarantee you get fair market value. It simply says the assets must be liquidated to protect the integrity of the retirement system. And who determines the price? The government does. They can mandate that you sell your silver at whatever price they set. And if you refuse, your entire IRA is deemed distributed. You owe immediate taxes on the full value, plus a 10% penalty, plus potential criminal penalties for noncompliance. They've created a perfect trap. You either surrender your silver at the price they dictate, or you lose your entire retirement account to taxes and penalties. Heads, they win. Tails, you lose. Now, let me give you the historical context, because this is not new. Governments have been confiscating precious metals from their citizens for thousands of years. But the most relevant precedent is Executive Order 6102, signed in 1933. The order required all persons to deliver all gold coin, gold bullion, and gold certificates to the Federal Reserve by a specific deadline. The official justification was that hoarding gold was preventing economic recovery during the Depression. The real reason was that the government wanted to devalue the dollar, and they couldn't do that while citizens had the ability to hold gold as an alternative. So they confiscated it. They paid $20.67 per ounce. Then immediately after the confiscation period ended, they revalued gold to $35 per ounce under the Gold Reserve Act of 1934. The government made a 69% profit on gold they had just confiscated from citizens at gunpoint. This is not ancient history. There are people still alive today whose parents or grandparents lived through this. The legal framework used in 1933 was the Trading with the Enemy Act of 1917, originally passed to give the government emergency powers during World War I. They repurposed a wartime law to confiscate wealth from American citizens during peacetime. And that law is still on the books. It has never been repealed. It can be invoked again at any time the government declares an economic emergency. But they've learned from 1933. They learned that door-to-door confiscation is messy, expensive, and creates bad optics. So this time, they're using the tax code. They're using the retirement account system. They're using a system where you voluntarily gave them custody of your assets. And now they're changing the rules on what they can do with assets under their custody. Here's how the mechanics work in practice. Let's say you have a self-directed IRA holding physical silver. You've got 500 ounces sitting in an approved depository. You're paying storage fees. You're filing all the proper paperwork. You think you're doing everything right. Then you receive a letter from the IRS. The letter informs you that your IRA holdings have been flagged for materiality assessment. It says that due to volatility in precious metals markets and systemic risk factors, your physical silver holdings are being deemed a prohibited transaction under revised guidance. The letter gives you 90 days to liquidate the position. It provides you with a list of approved buyers. And when you look at the approved buyers list, you notice something interesting. They're all government-affiliated entities or banks that are under government control. You call a few of them to get quotes. They offer you $71 per ounce. But you know the physical silver market is trading at $120 per ounce. You call your IRA custodian to complain. They tell you their hands are tied. The IRS has issued the order. You either sell to an approved buyer at the approved price, or your IRA is deemed distributed. You do the math. You have 500 ounces. At $71, that's $35,500. But you paid $90 per ounce when you bought it. You paid $45,000, so you're being forced to sell at a 21% loss. But if you refuse, if you don't comply, the IRS treats your 500 ounces as if you took a full distribution. At the current physical market price of $120 per ounce, that's $60,000 of taxable income. At a 40% combined federal and state tax rate, you owe $24,000 in taxes. Plus a 10% early withdrawal penalty if you're under 59.5, that's another $6,000. So your choice is take a $9,500 loss by selling at 71, or take a $30,000 hit in taxes and penalties by refusing. Most people will sell. They'll take the loss. They'll surrender their silver. And the government will have successfully confiscated precious metals from retirement accounts without ever calling it confiscation. Now, you might be asking, why would the government do this? What's the motivation? Let me give you 3 reasons, each more disturbing than the last. Reason 1 is dollar defense. The United States dollar is the global reserve currency. That status is under attack. Countries are abandoning dollar-denominated trade. They're creating alternative payment systems. They're accumulating gold and silver as hedges against dollar devaluation. If that trend continues, if the dollar loses its reserve status, the U.S. government loses its ability to print unlimited money without consequences. They lose the ability to run trillion-dollar deficits. The entire system collapses. Precious metals are the enemy of fiat currency. When citizens hold gold and silver, they have an exit from the monetary system. They can opt out of inflation. They can protect their wealth from currency debasement. The government cannot allow that, especially during a currency crisis. So they need to remove precious metals from private hands. They need to force everyone back into the dollar system where they have control. Reason 2 is revenue generation. The federal government is running multi-trillion-dollar annual deficits. Social Security is insolvent. Medicare is bankrupt. The debt-to-GDP ratio is at levels that historically precede currency collapse or default. They need money, lots of money, fast. And retirement accounts hold over $35 trillion in assets. If the government can confiscate precious metals from those accounts at below market prices and then revalue them at true market prices, they generate instant profit, just like they did in 1933. If there are conservatively $100 billion worth of precious metals held in IRAs, and the government confiscates them at 70% of market value and revalues them at full market value, that's a $30 billion instant profit for the Treasury. Multiply that by doing the same thing with other alternative assets, and you're talking about hundreds of billions in revenue without having to raise taxes or cut spending. Reason 3, and this is the most sinister, is control. The government wants total visibility and control over wealth. Physical precious metals are one of the last remaining stores of value that exist outside the digital financial system. You can hold a silver coin, and it doesn't show up on any database. It doesn't generate a transaction record. It can be transferred peer-to-peer without intermediaries. It's true financial privacy. And governments hate privacy. They want to know where every dollar is, who owns what, who's transacting with whom. Central bank digital currencies are coming. The digital dollar is being developed right now. And when it launches, it will give the government complete surveillance over every financial transaction in the economy. But people won't adopt a CBDC if they have alternatives. If they can hold gold and silver and transact outside the system, the CBDC fails. So the government needs to eliminate those alternatives first. They need to confiscate the precious metals, force everyone into digital assets that they control, and then they have complete financial dominance. No more privacy, no more opting out. Complete control. This is not speculation. This is the openly stated goal of central banks around the world. They've published papers on it. They've given speeches about it. They want to eliminate cash. They want to eliminate physical stores of value. They want everything digital, everything tracked, everything controlled. Now, let me address the obvious question. Is this legal? Can they actually do this? And the answer is complicated. Under normal circumstances, this would clearly be an unconstitutional taking under the Fifth Amendment. The government cannot seize private property without just compensation. But here's the trick. They're not calling it a seizure. They're calling it a prohibited transaction remediation. They're saying you violated the terms of your tax-advantaged account, and therefore the account loses its tax-advantage status. It's not confiscation, it's tax enforcement. And courts have historically given enormous deference to the IRS on tax matters. The Supreme Court has repeatedly held that the government has broad authority to set the terms and conditions of tax benefits. If you don't like the terms, you don't have to use the tax-advantaged account. That's the argument they'll make. You voluntarily put your silver into an IRA structure. You agreed to follow IRS rules. Now the rules changed. If you don't like it, you can take a distribution and pay the taxes. But we're not forcing you to do anything. This argument will probably hold up in court, especially if they declare an economic emergency. Courts become very deferential to government power during emergencies. We saw this during COVID. Constitutional rights that were supposedly absolute suddenly became subject to emergency public health orders. The same thing will happen during a financial crisis. Property rights, due process, all of it goes out the window when the government declares an emergency. And they will declare an emergency. They have to, because that's the legal justification for extraordinary measures. Here's what the playbook looks like, based on historical precedent and current regulatory trajectory. Step 1, there will be a trigger event, a currency crisis, a bond market collapse, a major bank failure, something that creates panic and gives them justification to act. Step 2, the president declares a financial emergency. This can be done unilaterally under existing emergency power statutes. No congressional approval required. Step 3, emergency regulations are issued by the Treasury and the IRS. These regulations reinterpret existing law to give the government expanded authority over retirement accounts. Step 4, notices go out to IRA custodians. All custodians holding physical precious metals are ordered to report those holdings to the IRS and freeze any transactions pending further guidance. Step 5, individual notices go to account holders. You have 90 days to liquidate to approved buyers or face distribution and penalties. Step 6, mass liquidation begins. Most people comply because the penalties are too severe. The government buys the metals at suppressed prices. Step 7, revaluation. After the confiscation period ends, the government announces that precious metals will now be priced at true market value for reserve purposes. They make a massive profit on metals confiscated at discount prices. Step 8, digital transition. With precious metals removed from private hands, the government pushes hard on CBDC adoption. They may even make physical precious metals transactions illegal outside of approved dealers, similar to how they made gold ownership illegal after 1933. This entire sequence could happen in under 6 months. From trigger event to complete confiscation, 6 months. And most people won't even understand what happened to them until it's over. Now, you're probably thinking, okay, this is terrifying, but what do I do? If my silver is in an IRA and they can confiscate it, what are my options? Let me give you the strategic framework, but understand that I'm not a financial advisor, and this is not financial advice. This is analysis of historical precedent and regulatory structure. Option 1 is to take early distribution. Yes, you'll pay taxes. Yes, you'll pay the penalty if you're under 59.5, but you'll get your metal out of the system before they change the rules further. Do the math. If you have $100,000 in silver in your IRA and you take distribution now, you might pay $45,000 in taxes and penalties. That's painful, but you keep $55,000 worth of physical silver in your possession outside the financial system. If you wait and they confiscate it, you might get $40,000 in forced sale value, and you still owe taxes on that $40,000 as a deemed distribution. So you end up with maybe $25,000 after taxes. By waiting, you lost $30,000 compared to taking distribution now. Run your own numbers. Compare the cost of exiting now versus the cost of confiscation later. For many people, especially those who bought silver at lower prices, taking the tax hit now is the better option. Option 2 is to convert your IRA metals to a different asset class that's not currently targeted. This is not a long-term solution because once they come for silver, They'll come for other alternative assets too. But it buys you time. You could convert to real estate held in a self-directed IRA, though that has its own regulatory risks. You could convert to conventional investments like stocks and bonds, though that defeats the entire purpose of holding hard assets. There's no perfect answer here. Every option involves trade-offs. Option 3 is to hold physical precious metals outside of retirement accounts entirely. Never put them in an IRA in the first place. Yes, you lose the tax benefits, but you gain complete control. The metals are in your possession. They're not in a depository. They're not under someone else's custody. They're yours. And when confiscation comes, they can't take what they don't know about. Now, I want to be clear about something. I'm not suggesting tax evasion. You have to follow the law. If you sell metals for profit, you owe capital gains tax. But if you simply hold physical metals that you purchased with after-tax dollars, there's no reporting requirement. You don't have to tell the government you own them. They're not in a custodial account. They're not in the financial system. They're just property that you own, like furniture or artwork. And when confiscation orders come, they're going to target the easy fruit first. The metals that are already in the system. The metals in IRAs and ETFs and allocated storage at major dealers. Those are all databases they can access. Those are all accounts they can freeze. But physical metals in private possession, they'd have to go door to door. They'd have to search every house. And they're not going to do that. It's too expensive, too difficult, too much political blowback. So they'll get what they can from the financial system and call it a day. If your metals are outside that system, you're much safer. Option 4, and this is more radical, is to expatriate assets. Move your wealth to jurisdictions where property rights are more secure. This is not an option for everyone. It requires significant resources and sophistication. But there are countries that have strong property rights protections, that don't participate in U.S. tax enforcement, that allow you to hold precious metals without government interference. Singapore, Switzerland, certain Caribbean jurisdictions. If you're wealthy enough to make this work, it's worth exploring. Because the U.S. government's reach, while extensive, is not unlimited. They can't confiscate assets that are legally held in foreign jurisdictions outside their control. Now, let me address the elephant in the room. Some of you are thinking, this will never happen. This is too extreme. The government wouldn't dare. And I understand that reaction. It seems impossible. It seems like something that happens in third world countries, not in America. But I want you to remember something. In 1933, Americans felt the same way. They thought the government would never confiscate gold. It was unthinkable. It was un-American. It violated everything the country stood for. And then it happened. And people complied because the penalties for non-compliance were too severe. History doesn't repeat, but it rhymes. The circumstances are different, but the underlying dynamics are the same. A government in financial crisis, running out of options, looking for ways to generate revenue and maintain control. Citizens holding assets outside the monetary system that the government wants to reclaim. Emergency powers that allow the government to suspend normal legal protections. All the ingredients are there. The only question is timing. Let me give you some indicators to watch, some signals that will tell you when this is imminent. Indicator 1, expanded IRS enforcement funding. Congress has already approved tens of billions in new IRS funding officially for tax enforcement, but watch what they actually spend it on. If you start seeing hiring for specialists in alternative asset valuation and retirement account compliance, that's a red flag. They're building the infrastructure for confiscation. Indicator 2, emergency economic measures. If the government starts invoking emergency powers for economic reasons, if they declare a financial emergency, that's your signal. That's when the door opens for extraordinary measures. Indicator 3, restrictions on precious metals transactions. If new regulations start limiting how much gold or silver you can buy without reporting, if dealers are suddenly required to collect more information about buyers, if transaction limits are imposed, these are precursors to confiscation. They want to map the market before they move. Indicator 4, media narratives about hoarding. Before the 1933 confiscation, there was a sustained media campaign about gold hoarders harming the economy. Watch for similar narratives about precious metals speculators, about how holding physical silver is unpatriotic during a crisis, about how people who own metals are preventing economic recovery. This is psychological preparation. They need to demonize holders before they confiscate. Indicator 5, changes to IRA custodian regulations. If you start seeing new rules requiring more detailed reporting of physical holdings, if custodians are required to verify the physical location and serial numbers of all bars, if there's increased scrutiny on self-directed IRAs, specifically, these are administrative preparations for action. Now let me tell you what's probably going to happen to the silver market when this starts, because the confiscation won't be instantaneous. There will be a period, probably several weeks or months between when the orders go out and when the forced liquidations are complete. During that window, several things will happen simultaneously. The paper silver price, the COMEX futures price will likely crash. Because forced sellers in IRAs will be dumping whatever they can into the futures market trying to hedge or exit. The approved government buyers will be bidding low because they know sellers have no choice, so the official price will show silver collapsing. But the physical market will do the opposite. Physical premiums will explode to levels we've never seen because people outside the IRA system will panic buy, trying to get metal before it becomes impossible. And people who successfully get their IRA metals out will refuse to sell at any price, knowing what's happening. We could see a situation where COMEX shows silver at $60, but physical metal is trading at $200 in private transactions. A complete decoupling. A bifurcation of the market into paper that's worthless and physical that's unobtainable. This price action will create a feedback loop. The government will point to the low COMEX price as justification for the low forced sale prices. See, the market price is $60, so we're being generous by offering $70. But anyone trying to actually buy physical will discover that $60 silver doesn't exist. It's a phantom price, a number on a screen that has no connection to reality. This brings me to the final and most important point. The question you should be asking is not if this will happen, but when and how to prepare. Because even if I'm wrong about the specific mechanism, even if it doesn't happen exactly as I've described, the underlying risk is real. Any asset you hold in a custodial structure, any wealth you have inside the financial system, is subject to rule changes, regulatory reinterpretation, and government seizure. This is not paranoia. This is how power works. Governments in crisis do desperate things. And we're entering a period of cascading crises. Currency crisis, debt crisis, demographic crisis, geopolitical crisis, all hitting simultaneously. The pressure on the government to generate revenue, maintain control, and preserve dollar hegemony is going to intensify. They will use every tool available, and the retirement account system, with $35 trillion sitting in it, is too tempting a target to ignore. They've already started. The infrastructure is being built. The regulatory framework is being established. The precedent has been set. All that remains is the trigger event and the political will to act. Your window to prepare is narrowing. Every month that passes, the noose gets tighter. More regulations, more reporting requirements, more government visibility into what you own. By the time most people realize what's happening, it will be too late to act. The accounts will be frozen, the notices will be sent, the 90-day clock will be ticking, and your only choice will be comply or lose everything. Don't let that be you. Don't be the person who knew this was coming and did nothing. Because I've laid out exactly what's happening. I've shown you the mechanism. I've given you the historical precedent. I've explained the motivation. The information is here. The warning has been given. What you do with it is your decision. But understand this. In 1933, when the gold confiscation orders came, people had a choice. Some complied. Some hid their gold. Some moved it offshore. The ones who complied lost 40% of their wealth overnight. The ones who hid it or moved it preserved their wealth and watched it grow as gold was revalued higher. History rewards those who see what's coming and act decisively. It punishes those who hesitate, who wait for confirmation, who hope things will somehow work out. The government is coming for retirement account metals. The legal framework exists. The motivation is clear. The timeline is uncertain but short. Your move.